Trade is with Mr. Scott Bauer, CEO of Prosper Trading Academy. All right, so you're looking at Southwest, right?
Yes.
Okay,
Yes.
Tell me why.
You know what? Love looking at this after earnings. And what you guys just discussed, I'm spot on with that. Margins are coming down. Expenses are rising.
So is that good for an airline?
You know what? It's not. It's really not. I think what the market is looking at right now, Oliver, is a little bit of a relief rally that, you know, everything from the 737 MAX is maybe not impacting or didn't impact the results as much.
We got our head around it or something?
Yeah, maybe so. That being said, technically, we're coming up here to some pretty decent resistance here, some short-term resistance right around this 55 level here. I think this rally is overdone to the upside. I want to look at a downside play now post-earnings, now that volatility has actually gotten crushed.
Okay, so here's where I'll make the argument to the opposite then.
Okay.
Here's a company that just gave us numbers that aren't exactly rosy, but the market's okay with it. Does that not tell us from the price action, from kind of a technical interpretation, that either they've got their head around the downside risks, or that maybe because the stock was an underperformer, you put United on here and it's going to be much higher. You put Delta on here, it's going to be higher. Is the market not telling us something this morning that it's okay with some of these pressures?
You know what? I don't really care what the market is telling us, to be quite honest, because remember, like we always talk about, we're talking about a specific trade, not an investment. Right? So I want to take advantage of this opportunity where technically this stock is coming up to this resistance area. And I think once the market digests what you guys just talked about the depressed margins, fuel costs were pretty good in this last quarter, but they're obviously going up here. So with volatility where it is, where volatility got crushed, I'm looking at a downside put spread going out to May expiration.
You're buying the May 53 puts, selling the 51. We're looking at it right now. Walk me through the structure of this.
Absolutely. So with the stock up here, the market is expecting, the option market's expecting about a $3.50 move out to May expiration. Now, we don't look at direction, we just look at the magnitude of the move. I think it's going down. If we get that move down, that puts us in the 51 to 51.5 area. So I'm choosing those strikes specifically for that move to the downside of what the option market is telling us that expected move is. Also, I can do this thing for 50 cents, probably a little bit less than that. The reward to risk on this, Oliver, is phenomenal. If this thing does make that move, this is a 3-to-1 reward to risk, right? If the stock does continue to go up, or let's say it even just sits here and doesn't go down, I know what my risk is. I'm capped out on my risk. So to me, this is a very low cost, very high reward type of strategy going out almost a month.
So if the thing starts to move upwards against the bearish trend, selling of that 51 put will hedge you out a little bit.
Exactly. So whatever I pay for this spread, whether it winds up being 45, 50 cents, whatever it is, that's my max risk. And that's the reason I'm not just buying a put on its own, but I'm selling that lower strike put to hedge some of that cost. All
right, there we go. Scott Bauer, CEO of Prosper Trading Academy, trading some airlines with us. Appreciate it, Scott.
Always.
Great work here. Pleasure having you in studio. All right.